Thank you for watching Resource Talks. This is actually Junior Mining Talks, and I thought that today we could do kind of a wholesome overview of what happened in 2024 and look at the losers and the gainers and maybe looking mostly at the gainers to see who made money in this market. But the reality is that the average the average result, and I'm judging Luke, by the way, from the Resource 100 page that you have. When I go and click on year, it says that we had this year on average, the average return was a negative 2.7%. So it was not a good year generally for junior mining. There's 659 winners, 38 unchanged, and 1,250 losers. So almost twice as many losers as winners. And when you start, I thought let's do the top 10 losers and the top 10 gainers or something like that. And that was way too simplistic of a way to look at it, because you sort them by performance starting with the negative, and you just get pages and pages of minus 90. I think the worst performer is just minus 99%. And then you go down pages and pages of minus 90 to minus 50, 60, 70%, so on. It's like basically a total loss. So it was a brutal year for junior mining stocks, like it is most of the time for most junior mining companies. And hopefully we'll get to talk about all of this and then some. I don't know how much time you have. I got plenty of time, actually. But of course, we're going to talk about nothing before I've warned everyone listening that although none of the companies mentioned or featured in this publication have paid us to talk about them in this episode, this channel is a business. This channel earns its money by charging junior mining companies for interview production, which means there is a high probability that some or even all of the companies that we will cover in here have either paid us for such interviews in the past or might pay us in the future to conduct such an interview. In addition, all of us are junior mining speculators, both Luke and I, which means we may own shares of companies mentioned in this publication, or we may have owned shares of them in the past, or we may own shares of them in the future. All of this is to say that you should treat this program as biased entertainment instead of unbiased journalism, because there will always be at least some type of bias in what we say in here. This entertainment program is intended only for experienced junior mining speculators, because mineral exploration, development, and mining is a very tough business. That's not something in most of the cases that you can call investing. That's why I'm emphasizing on speculators. And losing money is the norm and should be the expectation, as this is a very complex sector and the performance of individual companies typically depends on many different factors, including geopolitics, macroeconomics, commodity prices, and so on, but also company specific factors like the geology and the management and the jurisdiction and the laws and this and that, many other factors, most of which are not really foreseeable. Unfortunately, and believe me, I have tried, I don't possess any superior knowledge, and my crystal ball seems to be broken because I don't know anything about the potential direction of any stock or commodity price. And at least to my understanding, nobody out there does. So you should not rely on this program for directional advice or advice of any sort for that matter, as this is going to be a conversation that is general and impersonal in nature between a couple of individuals, none of whom are licensed financial advisors and none of whom can see the future. So no guarantees can be made about future events, and past performance is not a guarantee of future results. So before continuing on, please talk to a professional investment advisor with a good long-term track record, as well as do more research before taking any decisions by visiting setterplus.ca, where you'll find the company's official filings. And if you don't do that, you're highly likely to lose your money. That said, Luke, I'll bring it over to you because I really have no idea what's going on. I know some people think I say this as a joke or whatever, but I'm as serious as I can be right now. But junior mining is tough in the best of times, and 2024 was not the best of times. Interest rates, investor sentiment, everything, market volatility just kind of made it feel like climbing up. I don't know. I'm trying to make a mining joke, but I'm not going to be able to. So point being, this is really hard, but there is still a couple of names and that you've gathered here that did do well. I mean, I see you've gathered 15 names per market cap category. and the top 1, 2, 3 did really well. Like, I'm looking at the highest market cap category. There's two companies that did 670% and 620%. And the next category, there's one that did 2,900%. So then the other one did 1,000%, 790. Then there's a couple of ones in the smallest cap category, although that's the most iffy one, and we'll talk about that as well. But there's an 833%. And so there's companies that are doing well even in a bad market. What makes that, and how can I be in those names? Because I think I recognize, I have to take a deeper look, but I think I recognize only one of the names that I got in, and we'll probably talk about it. And I didn't get in at the low, of course, so I'm not making that entire gain, but just one name of what do you have, 45 or something. So I've still not cracked the code. I think that's clear. But what is the code? How can you crack the code?
Yeah, if you look at that first list of big companies going up a lot, of course you will see what we can call very successful companies. They really have something, otherwise you're not valued at 200 million or 500 million. So in those cases, you look at, in most cases, real successes. In the smaller categories, what you often see is indeed companies that have done really, really poorly over the years, but suddenly start doing well. It's interesting if you go to the Research 100 site and you go to the 1 year and you sort by not from high to low, but from low to high. And if you are familiar in this industry a little bit, you will find some interesting companies that are in that -70 to -100% range. And of course, it is for sure that a number of them will become 5 or 10 baggers, but not many. And what I've noticed in this exercise of going through it for this episode is, and certain things but you start realizing them more when you spend some time on them and you start figuring it out. There were a few companies in these three lists, the top 15 lists. One list is indeed the big caps, or the sort of big caps from 200 million, or from 100 million to a billion, and the other one up to 100 million, from 20 million, and the other one the small, everything below 20 million. And I've noticed that a number of companies in these lists are companies that I've owned and sold when I was completely done with them, and now they are in the best list again. If I would have kept them, I wouldn't even have made money. One example in the first list is Oh My Gold Mines, which was not a bad idea from someone who suggested it to me, and I bought that stock in 2020 or 2021, and I think it was around 14 cents, and the stock came down a lot, and now is among the best performers of this year. And I think one of the things what you see that very often when a company goes public or when a company buys a new project, or for some reason gets into the picture with investors, everybody wants to be part of it, or at least a certain group of people want to be part of it, and they all have high expectations typically, and also typically have a short time frame. And when you combine these two things, of course you will disappoint, because if you have, in Omai's case, they have an old gold project, big project, and if you are an investor, you are hoping for big intercepts and hopefully extensions of that deposit. And what these companies typically do, and I'm not accusing Omai or any other specific company, but what I've noticed over quite a lot is that companies, of course, start with a lower risk drill holes to infill a few holes, to confirm a few holes, old holes. And those holes typically do not really inspire the market, because people realize those holes are not new, and they are used as selling events for existing investors. So what you often see, if a company doesn't really come with something new in the very first months in a mediocre or bad market, the stock will just go down. And in Oh My Gold's case, maybe the expectation was, hey, I'm going to make money within a year. It didn't happen within a year, not in 2 years, but finally that company is doing well, and you would have made money like 3 or 4 bagger from the low if you bought the low. I was out at that point, and didn't participate in this run. And even if I would have kept my stock, well, I would have been in the green again, but maybe at a 50 or 60% profit at this point. So I think what you very often see is that projects can be good and have high potential, but the expectation level and the time frame around those theses, the thesis that you have to buy a stock, doesn't really play out. People want to see that instant gratification,
Mm.
immediately an amazing drill hole that changes everything, and that's not how it works. And the stock could go down 80%, stay there for a while, and only return to higher levels when certain events happen. And we can discuss what type of events, in my opinion, often lead to those recoveries.
I do want to talk about that, and this what you're saying here almost sounds like holding motivation, which it isn't actually that. I think um generally the idea is not to talk about specific names in the first place. I should have said that at the beginning, and their potential, whether they're done for, or whether they have a lot more potential here. My idea is that I want to talk about in general what worked in the market this year and why. And actually, what I'm getting from you is that this could be true in any year, because basically what I'm getting is that this game is not even so much about picking the right companies, picking the right assets, although that is of course part of it. Uh, it's not it. It's not the holy grail. It's not that you pick the right company and every time you pick the right company, you make money, because you have to pick the right story or business. We kind of agreed we shouldn't call them stories, although most of them are. But you pick the right company, you pick the right business at the right time when it's going to have the right catalyst that can be accepted by the market. The problem is that in a year like this, finding that story was kind of like drilling in the dark without geophysics while being blindfolded and drilling with your bare hands or something like that. It was just tough. And so that really makes me think, like, is this even something that I want to keep putting time in? Because again, clearly looking at your list, I haven't cracked the code. I did not recognize the vast majority of these winners. Again, there's one name I recognize on here and I know about it because you told me about it. Um, so I mean, why am I even trying in the first place? That's a question that keeps coming back from me. So is there a way to actually do it right for people like me that might not be intellectually gifted?
Well, in this first list of big companies, I mean, I think most people, I think you probably know about Power Nickel and G2 Goldfields and Mawson, and but the question, of course, is can you spot these things in time
Hmm.
that you still have the confidence at a certain level to buy these things, and sometimes these things keep on going because the story gets better and better, but of course you have also a risk reward thing to deal with, like we discussed about founders, where they have success, but you just ask yourself at 400 million, is it worth it right now? And that's not against the company, that's just your own risk reward type thing. And I think the timing is very difficult, but very important. Um, so if you are buying a company, for example, an IPOing company with a promising project, together with 80 other investors in a 2020 year, a bull market year, and the initial investors bought stock 90% cheaper than you, of course they will try to sell that stock earlier than you. So it's important that you go in at the right time. You don't have to know all these different names to get back to your question. You don't have to know all 15 or all 20 successful names. One is enough, or two is enough to really make a good return. And trying to be in every story in general, I think, is problematic because you cannot really know about every company in detail. You cannot be in 10 winners at the same time. So I think not trying to be in all these names is already a win. So I think spotting these things in time and the timing, I think it's important that you think about when a project is really not in favor, and that's quite easy. You go to the website and you look at everything between 70% down and 100% down. If you do that on a Saturday morning and you think today my screening methodology is let's have a look at companies doing really bad, and not just buying them because they do bad, but have a look at are there some companies that I know of, or maybe stories that I missed that are down for reasons that can be fixed. And I think in Oh My Gold's case, number 5 of this list, the project was prospective. The team probably was good. I'm not sure. I don't even know enough about Oh My Gold right now. But I've looked at it and it went up because they made a new discovery. They made an extension. So you need to give such a company a bit of time. And if you buy something like this, if you notice a company like this trading 90% lower than in its initial price, and you look at how much money has been spent on the project, and you think, wow, this project combined with the work done in the past and combined with who's running this company, and you call them up and you say, hey, why are you trading at $15 million? And you were trading at $100 million before, and if you get a satisfying answer in terms of, well, this is what happened, and this is what we are going to do, and we are going to raise money this way, and you get a good sense of how they're going to recover or restructure the company to make it work again. These sold off companies can be an opportunity, but of course, it's not just buying an 80% off company. It is trying to find out why it's down. Can they solve this problem? And is that potential still there? And if I just scroll through the list of companies down 70, 80%, I do see a number of companies that probably need my attention, at least for a bit of work, a bit of research. Like, why is this company here? Why did it fail? Can this be solved? And in that case, you can find a next, because there's another company in the second list that has the same profile. I bought it at 20 cents, thing came down to 1 cent, and now is the best performing company of the year. So same project, nothing, not much changed in those 2 years that I owned it, and the thing coming down to 1 cent, and now being back at 20 cents. From a project point of view and from a team point of view, not that much changed. It is a supply demand thing where people have cheap stock, sell the stock in the market. There's not enough exciting news for other people to pick up those shares, and then naturally the thing goes down. And when it's trading at 1 cent, of course, the risk is that they can never finance again to, sort of restart everything again. So then you have the risk of not being able to raise money. So if you can call the company and you get confidence that they can do it again in a proper way, well, then it may be an opportunity. And 1 cent, of course, is an extreme example, but that is the best performing company of the year, going from 1 cent to 18 or 19 cents this year. So I think it's really important to try to buy companies that are not in favor that much, unless you prefer to just buy a company after success, after a discovery, after a big investor comes in. That's, I think, a good strategy that would have worked with Montage this year when the Lundins came in. This would have worked with the Power Nickel, the number 3 of this list, when they made the discovery. You could have bought it after the success and accept to pay a bit of a premium to the recent price, but still with upside. So there's different strategies. If you like the idea of buying things that are out of favor, then versus buying something that everybody wants because it's IPOing, there's a lot of promotion ongoing, then of course buying something out of favor is better if you can find out how they will solve the issue, because of course there is an issue if the company is down 80%. So it is different ways of trying to find companies, find opportunities, and it is depending on the investor which one you prefer. And I think it's important to realize what you want to do and not just buy something because somebody tells you a story, you get excited and make a decision on the spot. I'm going to buy this because it sounds good. I think you always have to think about who owns it already. Why do they own it? Who is going to buy the stock after me? Is there going to be a market for this stock, or is it a distribution event? And many of these companies have been the worst performers of the year and are now the best performers of the year. And I think that's proof of this concept.
I think it also starts, well, it starts at the very moment you hear about a company, because the way you hear about a company is typically through promotion of some sorts. It might have been a company itself, their website, marketing documents on there, like the presentation and whatnot, or someone talked about it on Twitter or whatever it might be. Their news releases, it's really all marketing essentially. And part of it too, I think where a lot of the losses come from is that a lot of these names are promoted as a good way to get exposure to a certain commodity, which I don't agree with. I think the junior space, specifically what we're discussing here, is a stock picker's market. So it's a very bottom up market. I know you agree with that. I don't think that you can be structurally bullish on gold and therefore make a portfolio of gold explorers. Why I'm saying this is because it didn't work for me. I tried and I failed. And I lost money that way a couple of years ago. And so it didn't work for me. I don't think that's the best way. I don't think the junior market is the best way to get exposure to commodities. It is one of the ways that you can go if you're looking for high risk, high reward, if you have a lot of time, if you have the knowledge, and so on and so forth. Because there's a lot of, I think, I don't have exact statistics to say this, but I think many juniors never deliver on promises. So that the sector is not always driven by discovery, it's driven by marketing. So people have to be brutally selective and be able to be brutally selective. That's the main thing here. But is it, from what you're telling me, and your camera is going off focus again because it's getting tired to listen to me. But is this a sector that rewards hype over substance? Is that what this is?
No, I think hype is a factor, but it's very short-lived in most cases. I think it's important to either anticipate important changes in companies, because if you look at this list, it's often a team change. I call it team change. There's a little bit more to it, but or a discovery that really drives these companies. And I think anticipating a discovery is difficult because, well, sometimes you have the science. There's companies that really check boxes. They initially do prospecting work, then they do some channeling work, and if one after the other confirms something could be here, of course you could anticipate, I'm going to buy this before they drill. But it's difficult because in most cases it leads to no discovery with the drill hole, and then you're in the story. A team change is also, sometimes you can sort of anticipate the change in hype or the change in, and especially if a company is really out of favor, but still has people involved with the company that own a lot of stock. That's really important to me. I need to see that incentive for them. If the insiders do not own any stock, or maybe they owned quite a bit of stock in dollar terms when the stock was up, but now at 1 or 2 or 3 cents, their stock is worth almost nothing. I want to see enough proof that they still have an interest in making this work. And if it's a good team with a good track record, and they have, maybe they will load up at these prices in a private placement or through another way, but preferably I see the management already positioned with a big position, and it should it should be painful to them to see the price down, so that they have a motive and an incentive to really try to make the company work again. And if you then see them buy, for example, in the market, that's most important at these companies not doing well. So you want to see sometimes you can anticipate the right timing. And if you see them buying after a company crashed 80% and then finds sort of a level where it stays at, let's just say 5 cents, and you see that the insiders are buying, not every day perhaps, maybe every week or every month, and you see that they keep on buying stock, you can call them up and ask them, why are you buying the stock? Why do you think it's worth your money, and you're running the company? Tell me what's going to happen. And if they have a strong story, like, we think we have a good project, but it's out of favor right now because this or that happens, we need to do A, B, and C. But if that all works out, then we think this will work again. And if you ask, like, what would be the timing on this thing? What are the risks here? And you get a feel like, okay, they have pretty high confidence that they can solve this problem they have, or this issue they have. It could even be a jurisdiction that is not open to business for a while, but signs are there that is improving. Or perhaps the first couple of drill holes didn't give what people hoped for. The thing crashed down, and they say, well, this target didn't work, but we have a couple of targets that we're working on right now, and we are going to update the market soon, or whatever. I mean, whatever information you get, that you get a feel like, okay, they are buying in the market, they're sending out a signal, it's worth my money. It is at an all-time low. They still have a bit of money in the bank, or they give you the confidence they can raise a proper financing. And in those cases when nobody really wants the stock, and you think, well, in 3 or 4 or 5 months' time, people want this stock again, but people need a news release. They need a new presentation, a PowerPoint presentation. They want to see, an update, a company that's updating the market very regularly. And I think you want to be in the company before it all happens. And with Editon, which is part of the second list, the biggest mover of the year, 3,000%, the company, there was no interest for the company at 1 cent. And now suddenly the company is up 30x, and there's interest again. And of course, there were signs at the low that they were solving things. They did debt settlements, they did financings, some new people arrived. And I didn't catch this company in time, and I didn't notice it in time. But if you would have called the company like, hey, you're settling your debts, you're doing financing, you have new people involved, what's happening? If they could have given you an answer that gave so much satisfaction that you think, oh well, at 1 or 2 or 3 cents, I'm willing to also participate here, and you would have been in this 20 bagger or 30 bagger. So I think it's important also to screen for those bad companies, if you will, if you are willing to do the work. If not, then of course it's better to stay with companies that are not in deep trouble. Uh, but then try not to buy the hype, of course, because there's many hypes every month, and most hypes end in nothing. So buying the hype only if it's based on a big new discovery or a big team that changes everything. In my opinion, it's always team change or discovery that really makes a big difference for these small companies.
That's something that you and I have touched upon before, I think, but half the trick, and it's not really a trick, half the battle, if you want to call it here, is saying no to maybe it's more than half, but most of the battle is saying no to most things that
Yep.
cross your desk in whatever way. I think you've told me that you could probably make more money yourself personally for you in your personal situation. So this doesn't apply to everyone, of course, but you could be making more money if you did less. And I think that's a big takeaway too. Yeah, I don't really have a question too, but I think that's one big takeaway that I had in 2024 is that half or more than half of the battle is saying no to most things.
It's extremely difficult, even if you realize it. Even if you realize it, if you follow this market closely, every day there's 1 or 200 news releases, and you're screening them. You're looking for things. What are you really looking for? You're looking for new opportunities, and opportunities often lead to nothing in the long run because most companies fail. Um, so in a way, it would be better to just do 1 or 2 or 3 transactions a year, only when you see that big event. And that big event, I mean, going back to our first list, the big list could be when Power Nickel hit that discovery. I didn't buy it because they had these 40 million warrants outstanding. And again, I miss discoveries every now and then because I don't like the way the company is structured. But if there's a breakthrough discovery, those things go out of the window, and the discovery is more important than other things. But so you can wait for that big news release that you are able to also to interpret, because some discoveries, this one was, I saw the opportunity in power nickel, but I was a bit concerned about the size of the discovery combined with the warrants. I didn't really feel like it was certain enough for me to buy it. In other cases, you see, for example, montage number 9. I saw the announcement of the Lundins really stepping up their game in that company in March or in February, I think. And this was for me a very clear signal. Like this company has been going sideways for a long time. Why would it now go down? Now that the Lundins really step up their game, buy way more stock, new team comes in. There's no reason for this company to go sideways for years. And after this development, going down. So the first thing is going down, unlikely. Going up, in my opinion, was likely, and it happened. And it's one of the best performers this year. I sold it a little bit too early, but still, if you go in with size, a double is amazing, or a triple. And basically, I try to say that if there's no three-bagger potential, why even try in this market? But if you dare to go in with almost, unreasonable size for your own portfolio, then better take it a little bit shorter in terms of timing. Just buy it and sell it a bit earlier, or at least part of it. So I think if you have something where you have really high confidence, then doing 1 or 2 or 3 or 4 transactions a year may be less risky. Of course, if you end up in a good market, everything starts going up, and you have just started your new way of just buying these big things, and there's nothing big to buy at that moment, you are missing a bull market. So there's always a risk of missing out on things, and that's, I think, the trouble is you want to be part of these winners. You want to be part of a bull market, and being afraid not to be part of it, makes you buy all these different stocks, of which most of them fail. So it's still, you keep learning, you keep developing new ways of looking at these opportunities and risks. Um, But in some cases, I think it's better to just, or maybe it is in general better not to get involved in too many names, but just own a couple of them that you have a very high confidence level in.
Hmm. And again, that is, I suppose, part of the portfolio that you're willing to risk into a sector that most of the times loses you money, and where the expectation is failure. And I might have misspoken earlier when I said, I don't know these names. It's not, or I don't remember exactly what I said, but so some of these names I recognize because I've spoken to them, seen them at conferences and whatnot. But it's more of like they're not in my portfolio. The idea was not even there for me to put them in my portfolio in the first place at the price that you've noted here as close of 2023. I would have thought that by now I would kind of get it though. Like I would have expected by now to look at a list. Like if you asked me whatever 3 years ago or whatever when I started getting more serious about the space, I would have expected that, okay, you give me 3 years, you show me a list of the winners, I would have at least considered going into some of them. And that's just not the case here. Like it's a very low number. And so I appreciate your positivity, but I think I'm kind of losing my positivity here, because is there a chance to do it right? Yeah, sure. But it's way harder than you think. So like what I thought, triple the way how hard you think that it is. And it's also not for everyone. So maybe it's not for me. Maybe over time I decide that this thing was never for me, and I just can't do it. And if you're in this for the long run and you're willing to dig deeper than the average speculator, I might have a shot. I'd like to believe that, and so of course I'm not giving up or anything. This is not my bye bye. You're never going to see me again. But it's making me think. Like I'm willing to have patience and go through losses and do more work, and I can afford to do that given the nature of my business. But this isn't a fun sector. I think that's kind of what I'm getting out of it. It's kind of a grind, and for every big win, there are countless disappointments, right? And that's maybe also the main reason why the industry cannot attract and sustain investment from serious investors. It's mostly speculators in the market, from what I could see. And again, I don't have the exact data to claim this, but that's what my gut feeling is telling me. And yeah, again, I don't necessarily have a question, but you kind of see where I'm going with this.
Yeah, I think the market, if a market goes down long enough or sideways, it makes you feel, lose confidence in even investing in this business. I started in the sector in 2012, and I started, I think, well, 2011, but I only owned one or two companies that year. In 2012, I started buying more stocks, mostly in August. There was a nice run of 3 months, and then it tumbled again, and it took 12, 13, 14, 15, like 4 or 5 years. And after 4 or 5 years, your belief is not getting stronger. But I kept on analyzing companies, and I was really focused on the companies itself, and found a number of companies, even Abitibi royalties, which was cheap by then, 50 cents, and went to 30, I think. I've been studying it for very long, didn't have the confidence to buy it because the market was bad. And so I think there's opportunities enough. It's just like, how do you build confidence? How do you know when to buy them? And how do you know when not to buy them? I think it's very easy to see every opportunity, but making the right decision. This list of 15 biggest companies, the biggest winners, I think I owned 10 or 12 of them. And Power Nickel I didn't buy because of the warrants. Oh My Gold I bought at the wrong time, and I sold at the wrong time. Q2 Metals I didn't buy again because of the warrants. Via Gold in Namibia, I bought it. I saw all the signs of a new discovery. The market didn't really pick it up yet. The results were not stellar, but they were pretty good. And after a number of months, I felt like the discovery is probably not developing as I expected. I heard some good things from Namibia, but not the confidence level I needed to stay in the game. And then over time, the discovery developed. It never really gave this amazing drill hole, but it was good enough for them to build a pretty impressive resource. And now it's one of the best companies on the exchange this year. So I didn't have the patience for Via Gold, so I sold it. Montage Gold, I did well. I sold too early, if you could say. Well, you can never sell the top, but anyways. Founders Metals, I got offered at 20 cents. Didn't do it. Mawson, I bought at 17 cents. Sold it too early. G2 Goldfields, I owned it. Sold too early. American Gold, bought it at 4 cents. Sold it at 8 or 12. Of course, still a win. But looking at where it is right now, bad decision. Maybe not bad decision. You cannot really buy them at the bottom and sell them at the top all the time. it's been pretty painful to see that I owned most of these companies and didn't really have one really big winner from these from a dollar point of view. In my case, there's not one name there that really made a big difference other than Montage Gold, I think, for me, even though I owned most of them. So finding these opportunities, seeing these developments is quite easy if you follow the news every day. But picking one and going in with the right size at the right time for the right duration, I think is the complete challenge here. How do you buy the right thing and at the right time and keep it long enough that you really make a good return? Either with a big position and making a double would be enough to really make a big return for yourself, or with a smaller position, but trying to make that 5-bagger or 10-bagger position from begin to end. I think your own psychology finding these opportunities is quite easy. They present themselves every day. You see the news, and it's not difficult to see the one or two good ones every day, and then judging if they're good enough for you to buy them, or if a situation is developing in a way that you can buy a company. I think the difficulty is really, when is it good enough and certain enough for you? When do you have the confidence to put money into it, put the right sizing into it, and then the duration. How long can you hold on to it? How long do you have the confidence? And when do you see a red flag and you sell it? That's, I think, the game here. I think seeing the opportunity, I was in 10 or 15 of these names, and I think it was not a very difficult thing to do. It was just noticing something that attracted at that point my attention. But if you see how much I could have done way better looking at these returns in these companies, and I didn't. So it is fun, I think, trying to get better at making the right decisions, doing the right things. And psychology is a very big factor, I think.
And I think you bring up three good points as well here, because when I thought I'd started to get it, I thought at that point that it's really important to know what you're going to buy. And it is. But that's really only when the work starts. So you figure out what to buy, and then you have to figure out when to buy it, how much of it do you buy, and then you also have to figure out when to sell it. And these three things are actually way harder than the what to buy, I think, because there are good companies out there. You can find them. It's probably the majority of the sector is not good, but there are good companies and you can find them. That's not really the hard part I've found over the last couple of years again. So yeah, I mean, what kind of pointers do you have, or like dealing with these three things: when to buy, how much to buy, and when to sell? You say, when to buy, it's kind of a before a catalyst. But what about contrarianism? I mean, do you buy during extreme bearish sentiments? Do you buy after M&A? Do you buy alongside insiders? Because we see that too, but are insiders in our space necessarily, the best traders? We don't know that. And so yeah, let's maybe start there. When to buy? How do you qualify or quantify that, even if possible?
Yeah, I want to take one example. I want to take the second list, the companies between 20 million and 100 million. And number 5 is Corex Copper. This company had a different name in the past, but this company really did well this year. And initially, it was not clear to me why. And later on, it appeared that Haya Dawn from Orsino and Alan Friedman, two names who have, Ross Beatty as backer behind them typically, and have done well for in multiple companies for many investors. And when these type of people join a small company, and you can understand why they join, that's typically a moment to consider a company. But in this case, this company already went up quite a bit. So either those financings were already, maybe the backers were already positioned in those initial financings, or there was a bit of a rumor, or for some reason this company already went up the moment that those names came out. And that's not a surprising thing. That's just what happens all the time. Not even this business, it happens in every business, I think. So then you have to consider, okay, it is a significant event, them joining the company. It de-risks everything. It de-risks the ability to finance. It de-risks the project, to me at least, because I am not able to evaluate this project. It's above my pay grade. Them joining sort of suggests that they have done enough work that they think this copper deposit will work or could work. So I think this is normally an event, at least to take notice. But then the question is it an opportunity. And in this case, the company already went up quite a bit, and I didn't really know if it was still, well, I think it is still a buy, but I would rather be a little bit closer to the bottom in terms of entering the company, and the stock went up too much for me to buy it at that point. And I just say, nah, I will leave this one. Maybe missing out on a big win, and I think I did. But accepting that I'm not sure enough, so I let it go. In Montage case, to come back to Montage again, you had 1 or 2 days to buy, even if you have a big portfolio. I'm not talking about Eric's portfolio size, but let's just say you are willing to buy $500,000 worth of a junior. I think there was enough liquidity to buy $500,000 of stock of Montage in that 70 cents range. And you could have doubled your money in a month. And tell me how Montage would completely fail in that specific month when the Lundins came in. There's always a scenario, of course, that it could happen, but the likelihood was not very high at that point. So I think waiting for an event that gives you the confidence, because you understand that event enough to judge this is an event I want to get into. And that could be, again, a company making a discovery. Ramp Metals announced it, opened at 28 cents, I remember, and then very quickly went to 50 cents. At 28 cents, it was clear to me it still had upside. At 40 cents, when I was still buying, I felt like this is a point where I'm not confident enough to really continue, because it's getting to a market cap that maybe the market suggests is enough. So I think you need to have the ability to judge a situation. That could be at an event, at a news event, or it could be just a company being in a bad situation, but with a good team, calling them a few times and building confidence that they can repair the situation. So I think there's a couple of ways you can play this game: news driven or looking for opportunities because of undervalued companies.
My conclusion is still that it's quite hard to do all of these things.
One thing could be enough if you just have one way to play it. If you think, I will wait for that next big event that I understand, I mean, I will accept not to buy one stock if I don't see that one event that I am confident in. I mean, that's very difficult, because if you follow the market every day, which you have to if you do this, then you see lots of opportunities, and you have to pass all of them until you see one. For example, the Montage one, where the Lundins came in, just as an example. So that could be a strategy to just say, I'm not going to buy anything until I see something that completely makes me like, yes, this is the one I'm willing to put 40% of my position into, my portfolio into. And I'm not an advisor, so this is probably not the advice your banker would give you, but it's just a bit of a scenario. I think that could be a way to play it, to go in with significant size in terms of your portfolio, but only when you see something that you really understand, and let all these opportunities go, which is probably the most difficult thing.
Yeah, and only when you know or when you're certain. I think that's difficult too, because sometimes you can think you're certain, but you actually don't really even have enough data to be certain. I think that's where a lot of the problems.
And then it's a no, right? The answer is no. You're not certain enough. I have every now and then, and sometimes it has 6 months of nothing, but sometimes I see an announcement, or I see a development where I think this is going to work, at least short term. I mean, there's no guarantee. I mean, especially if you would invest for a year, for a longer period of time, that's more of an investment. I mean, now you can also put in the trade versus investment. Of course, investment is long period. You have several risks. I mean, the markets in general could crash. Whatever 2008 event happens again, and you are sitting in this illiquid junior, and no matter how well it's doing, the thing will go down because the market melts. The market tumbles. So that risk is, or there's an event with the jurisdiction, or there's not an unexpected situation. So investing for a long period, in a way, could be lower risk because you have a long time frame, but you also expose yourself to that risk for a long time. If you would do it more from a trading point of view, you could say, I'm waiting for this big event and I'm investing at that point. But you have to say no a lot, and only invest when you feel confident. And you, of course, you need a level of understanding of the industry. If you don't understand a thing and you need a newsletter writer to tell you what to buy, of course, then that's not a strategy. Then you are not able to pick these things. Then it's a different story.
Exactly. This is all kind of with a prereq of saying, you have to understand the space to begin with, which I think is still a challenge for me. And it is a complex space as well. And even then, even if you hit the right moment to buy something, how much of it do you buy? I mean, how much of a position do you make it in your case? And again, you do this full time. I believe your almost your entire portfolio is in the junior space, and this is what you do all day. It's essentially how you feed your family, if you want to put it that way. So this answer would probably be different for you than for most people. But what do you think about starting small and scaling in? So starting with a 25 or 50% position of what you think you might need at the end, and then adding or lowering your position on positive or negative news respectively. What do you think about that?
Yeah, for sure. I mean, there's no strategy I think that, well, there's strategies that don't work, but this is a strategy that could work too. I always try, it depends a little bit what the reason is of your investment. I also have companies where you just really think that you have a very critical management team, but there's just no discovery yet. There's just, I mean, you see that they are assembling a package or they are just doing the early work. But you think because they are good at raising money and you feel like a bit of good news could already get the stock higher, and waiting for that big discovery is not something you want to do. You want to be involved early. Then you're taking, it will take a longer time to get to the drill stage. Waiting for drill results, in my opinion, is always risky because they almost always disappoint in companies that do not have a discovery yet. And every time they disappoint, the stock will go down again. Can you live with that psychological effect of the thing going down again and going down again?
Hmm.
So in that case, if you don't like being, going in with a very big position and waiting for years and years and years, hoping for them to make a discovery and disappointing the market time after time, then having a small position in such a company, and the moment they have a breakthrough, for example, and in most cases that would be a discovery, then go in with bigger money. Well, I mean that would be a strategy too. And it's also, I'm not trying to say that what I just said is the way to do it. I'm just always thinking about what are strategies that work for me, and I feel, and I think this is for many people the problem, that when you follow the space every day, which you almost have to do if you want to play this game, that you get presented too many opportunities, and you always think, maybe I should buy this because this investor is buying the stock.
Hmm.
Yesterday, La Mancha bought Bellow Sun, a permitting problem project, but a good project in general. I think it's a big project. It was worth hundreds of millions, but failed in permitting, and now they're buying it. Do they know something I don't know? Am I going to buy this? Do I know enough? Do I have enough confidence? Or am I just buying it because La Mancha went in? That's all kinds of questions you have to raise it before you buy the stock, I think. But
Hmm.
so I think it's you need a level of confidence. You need to have, if you're not experienced, you cannot play this game with a lot of money because you're going to lose it. But if you play this game, you don't have to do it full time. I did it next to my job in the past too, but I spent a lot of time researching because I enjoyed it. And I think in that case, you can think about these different strategies and try to find these opportunities.
Hmm.
But again, different strategies can all work. But I think it's important that you realize what is your strategy, what are you trying to do, and not just buy it and we'll see later.
How much time does it take to realize stuff like that of what you've really been telling me this year? And I've learned a whole lot from you, but how much time does it take for you to kind of become secure in that strategy? You're like knowing that you know what you're doing. Because I actually had a positive year this year with my portfolio. In my opinion, largely due to luck, largely due to stuff that crossed my desk and talking to other people, not due to my strategy. And so I don't feel secure in my strategy. Like if you say, the internet disappears tomorrow and you can only do the research kind of old school way or whatever and place trades, I'm probably not going to have a positive year, unless it's some kind of luck based something where I looked into something. So I'm not secure in my strategy. My question to you is, how long is it going to take for me to become more certain in my strategy?
Well, I think you have to, if you enjoy this industry, you have to start buying things small and learn as you go. I lost money, but nothing that killed me between 2011 and 2016, I would say. And you should never consider yourself, in control and think now I know how it works, because then you of course are going to make a mistake. But I do feel if I consider this a bit of a career or a trick or whatever you want to call this game. I feel like since 2016, I started understanding the industry better. In 2013, I was just following somebody completely blindly because I felt, hey, this person is a good presenter, um, seems to have high net worth, and if this person is buying it, it's probably a good thing. I bought it. I had no idea why that person even bought it. I had no idea why I was buying it, only because the person was mentioning it. And then that person never mentioned it again. And I felt, why do I own it?
Hmm.
Is he still owning it? And it's just stupid. I even thought about companies like, hey, this company will likely produce this number of ounces. If the price goes up $1,000, the margin goes up $1,000. That would be amazing. The stock will be 100 bagger. Let's just buy it. I didn't count in. I didn't even consider dilution. I didn't even consider warrants. I didn't, consider that these companies raise money at least once a year. So all these things are very important to consistently. Well, consistently making money is also a problem because it's almost impossible to do it. You will make mistakes and you will lose money, but of course the strategy is to make money every year in this industry, even in a bad year. That would be the
Hmm.
ideal outcome. And if you're always fully invested and quite broadly in the industry, you cannot do that. This industry has too many bad years to make money every year. Then you have to be very selective and do a bit of trading. And again, Montage, I didn't even know the company that well. I talked to them once or twice at a conference. I heard about it from many companies. I knew broadly what the project involves, and and when I knew that there were many ounces in the ground, but I didn't know certain enough if those ounces could be mined profitably. And when I saw that announcement that a really typical Lundin family team, a bit like how they created Lundin Gold, for example, took sort of control of this company with a big investment from the Lundins at a level that the company was trading at for many years, not really able to impress the market. And now them coming in with their team, I felt like this is as certain as I can get it from a news release point of view, something that completely changes the company. And at 70 cents, I felt that was the easiest bet this year. And maybe it would have been better for me to just make that trade this year, not with 3% of my portfolio, but with 30. And of course, now in hindsight, it's even easier to conclude that it was easy.
Hmm.
Sometimes the moment itself, of course, you have doubts. But I think that was the easiest one this year. And maybe it is important to wait for an event. It doesn't even have to be a news event. It could be you spotting a company again at that low at at that point where it went 80% down and calling the company 3 or 4 times in the period of 1 quarter and concluding, I think it found the bottom. If not, I feel confident to buy a bit more. I start accumulating this stock in the market because I talked to the management team. They seem competent. They are buying the stock themselves. They have a bit of cash left, or they explained they made you comfortable how they will raise money in the future. And you like the project enough that at least from a speculative point of view, you think that the market will appreciate this project again in a couple of months' time. Whether or not this project will really become successful is even a different question. But sometimes it's easier to predict what the market is going to think about a project than the actual outcome of the project. And that would at least de-risk your position. If you can buy a stock at 4 cents, which was trading at 30 cents 2 years ago, and you buy it at 4 cents, and half a year later, the permit came in, the presentation was updated, a presentation was given at a couple of conferences, people talk about the company again, and only those things made the company go to 12 cents. You take 50% off the table. You made a three bagger. And if you like the project enough, then you stay for that potential discovery. That could be another strategy. And of course, it's always easy to sort of say it this way, but I think it's important to think about how you want to sort of play this high risk game in a responsible manner. And it's always difficult to say responsible because playing this market is not really responsible in the first place. It's a super risky market. But over time, if you enjoy it, you get better at it, and you find new strategies that work um, better and better, and you will still make mistakes.
And you will still make mistakes is kind of the most important part of that too. I think I've interviewed Rick Roll countless times at this point, and I've asked him many times about his past mistakes, and so he says he still keeps making mistakes and stuff like that. I think one big part here, though, to caveat what you just said with is, talking to management and maybe you trust them or whatnot, is taking into account your own what do you call it, naivete or something, or like naivety, is that a word? I don't know. You being that naive, which I am still, and I don't know if that's ever going to change. Maybe that's just literally who I am. I hope it changes with the experience, but maybe it doesn't. It's because junior mining is a playground, if you will, for big promises, for over promising. Let's put it that way. Junior mining is a playground for over promising and under delivering, right? So big promises that often turn into big disappointments. And they talk about these things. I even put it in my Christmas message on Twitter. I don't know if you saw that last week sometime. I said, may your Christmas be as hopeful as all the pictures from all the Exploricos operating in underexplored elephant country with district scale potential, mineralization open in all directions, and a geophysical anomaly bigger than a 43101 compliance manual. Because that's what we always get to hear, right? It's always tier one potential. There's excellent infrastructure and all these things. And if you are naive, recognize that. I don't think there's should be shame in that, and me saying it out there, but recognize it and know that there's the potential that what you're presented with may not, or what you believe to be true may not actually turn out to be true, right? So what sounds doable on paper could be, and again, I don't have the hard data to claim this either, but I believe that oftentimes, not could be, but oftentimes what sounds doable on paper doesn't really happen in real life. Everything takes longer and everything's more expensive and there is more dilution than you expected and the permits are harder to get than you expected and all these things. It's kind of my gut feeling, experience, if you will. So I think yes to what you said, with the caveat of understanding your own limitations when you call up these management teams, because they're trained salespeople essentially. They sell stock, right? That's what that they have the ability to print their own paper and sell it to you, and that's kind of their job. And understand those two things. Understand that that's their job, and understand that you might not completely understand it. I think that's been a bitter lesson for me as well.
Yeah, and realizing that news releases are indeed a marketing tool,
Hmm.
which is not completely fair to say, but in a way it is. Of course, if you look for news releases, then the key ones, the really like something that really changes. I hate the game changer words, but the game changer. I mean, the discovery could be that, like I said, the new backers, new investors, new CEO could be, but many news releases with the description of recent results are a little bit like a playbook, if you will. In March, we're going to grab some rocks from the ground, we put them in a bag, we send them to the lab, and then in June we will have a news release. And then in July, let's update the market by then about this EM. And in August, let's update them about this IP. And then in September, let's announce a drilling. I mean, sometimes the playbook is already clear in the beginning of the year, and you have to realize that you're also being presented a story. Indeed, we talked about this recently. Like, why do people call this a story? Well, maybe because a lot of these things are stories, and people have to start believing in these stories, and some of these stories become true, and that's why we look at a list of 10 and 20 baggers sometimes.
Hmm.
I think you have to be very optimistic and very skeptical at the same time. I really enjoy this industry because it is fun to try to find these things. You try to play a little bit detective. At the same time, I'm skeptical about every news release. But when I see something that makes me realize, well, if the market starts realizing this, then they will buy it. It's for me easier to predict what the market will like than what the actual outcome will be. And for the last time, I don't want to continue about montage too much, but you know that Lundins will almost always get positive reaction in the market. They join Sanu Gold, Sanu goes up. They join Montage, Montage goes up. Of course, you have to ask yourself what would be a reasonable market cap for them joining. I mean, it was a $5 million company. What is it worth right now? This was an $80 million company. What is it worth right now? How much are they going to dilute the company? Do they still have debt? Are they going to settle it for shares? You could buy a company for $5 million, and two transactions later, the debt settlement and the financing, the company is worth $15 million, but the share price is still the same. So you have to factor in like what happens if they settle the debt, what happens if they raise the money, including the warrants, and you exercise all those warrants as well. What is the company worth by then at the share price I'm buying it at? And often it's double the market cap. So you have a if you're buying a $5 million company, you're actually buying a $10 million company, and you have to consider the opportunity for could this be a 20 or $30 million company? Otherwise, why buy it? So there's many factors indeed that you have to consider, but it's a fun game. And when you're looking for turnaround stories, I think it's crucial to if you really look for something that has been bad for a long time and you want to spot the turning points. It often has to do with share issuances. So financing, who takes that financing? Debt for shares, who is getting those shares? New people joining a company. Why are they joining the company? Company changing the name. Why are they changing the name? I mean, there's a reason behind a name change. A name change in itself is not significant. I wouldn't buy a company for a name change, but sometimes it sends you the signal they are going to change something. They don't even have a new project yet. Why a name change? And when you call the company and they tell you, well, we have been evaluating projects for 6 months and we may, change business or we may buy something. Or, I mean, sometimes a bit of information is enough for you to conclude this company is going to start something new. Well, at this market cap, maybe it's an opportunity. So there's all kinds of ways to find opportunities. But again, we just said it's also a risk because if you look at too many of them, maybe you take too many of these bets. You want to play 20 different bets and you don't really know anymore after 6 months why you have these 20 companies. So it has all these different things to consider. Are you going to sit with your 3 or 4 companies and just manage those? Or are you going to place 20 bets and potentially forget why you own them? It's all part of this game. And I think for me, the conclusion is less is better, and know what you're doing at all times. Know why you own company A until company B, C, D, E. Otherwise, you will lose money.
Have you had your IQ measured? Like, have you done an IQ test ever?
I don't even dare because I'm afraid that it will be a number that will frustrate me for a long time.
Well, and I tried to do one this year, but I couldn't get through. Like, you had to sign off disclaimers and whatnot. Maybe that already tells you something about my IQ. But my expectation, in talking with you has always kind of been that you're dozens of percents ahead of me. So let's say, I don't know, my IQ is 100 or something, and being hopeful here. And let's say I would have expected yours is now 120 or 130, so 20 or 30% higher than mine. And that is one of the reasons why you've been successful in this. But now listening to what you're saying here, I think that maybe IQ can be thrown out of the mix as far as it's sufficient. Like, as far as, well, obviously your IQ is above average. I mean, that there's no discussion there. But it's also the way you're inclined toward the sector, I think, that's added a lot to your, and I'm talking off the cuff here. This is not prepared, so I might say silly things. I'll preface it with that. But the way you look at the sector, because what's out there a lot is you either have skepticism, but only skepticism, pure negativity, really, where people are just like, everything is bad, every news release bad, just everything about the sector is bad, and they're actually right most of the time. Or you have the optimists. They're often related to the companies in some way, or would benefit by the company going up in some way. So they might be, it might be paid promotion, it might be the promoters within the company itself, so the CEO and whatnot. But it's kind of like, it's almost as if you have only those two groups. Like, there's no other way. You're either an uber optimist and copper's going to $50, and therefore your pre-discovery company is also going to go up or something like that, or you're a pessimist and nothing ever works out. But it seems to me like success in junior mining requires, and this is not going to make me popular at all because it is boring, but it requires a balance between skepticism and optimism. So this is basically what you told me. Without skepticism, you're going to buy into every single pitch that you hear, every single stock that you hear mentioned on Twitter, because the story is always beautiful. It really is always beautiful. That's what happened to me at the beginning, like being naive and not being skeptical enough, buying into whatever was promised. Without optimism, though, you're never going to take the risk needed to have one of those big wins that you have in this in the list that you send me. I don't know, again, most of those companies intimately enough to talk about them, but I'm sure there's red flags with each one of them. I don't think there's a perfect company out there. I don't think that exists. I'm sure there's red flags with each one of them. And if you let every red flag, meaning, stop sign where stop, don't go in, because you approach everything with skepticism and no optimism, you were never going to be in these names to begin with. So it's kind of like a weird, well, not weird, but a challenging balance between pessimism and optimism at the same time. I think, am I making any sense here?
Yeah, yeah. I don't think you need a very high IQ to do well. Being persistent and keep doing it, trying to learn is enough. I don't think I will beat enough people to if I would compete with my IQ. I just think that trying to understand why things. I really look at things in a very simplistic way. I think you need to do the work. You need to spend time if you enjoy it. But at some point you realize that companies doing well is often for the same reasons. And I think the most difficult thing is keeping the stock. I think people who can really hold the stock 10 or 20 or 30x is often the insiders because they would have to file if they sell it. And they feel, there's a level of resistance there. They wouldn't do it because it would look bad on them. Or people who are naive and they keep the company, until it's a 30 bagger. It's almost like there's so many risks that it's almost stupid to keep a company for so long. So yeah, to go back to what was your main question here? Because I think walking away from your
It
question.
was really just a rant of my expectation that what's been a big driver of your overall success, not necessarily being. I didn't ask you how did you do this year. I assume you were in the green. Tell me if you weren't, or tell me how you performed if you feel like talking about it. But that you've done well over time, I think it was due to kind of the balance between pessimism and optimism at the same time. That was kind of just a rant about that. But yeah, you can talk to me about how did you do this year? Did you have a good year?
I didn't, to be honest, I don't even track my portfolio that well. It's green, but what I do is I have an old style Excel file that I update every month, more or less, sometimes every 3 weeks. And since I am spending quite a bit, I have no income. There's money going out all the time. So I just sort of measure my cash balance and I measure my portfolio worth basically. And these things are based on such illiquid stocks that giving a real value to a position is almost not responsible. So if a
Hmm.
company is trading at 10 cents with no liquidity, am I going to give it a 10 cents value? Of course, that's the price point where it's trading. But is that what it's worth? Because if I have to sell it today, it trades at 5 cents. So yes, I am well in the green this year. If I just look at the exact share prices right now, if I start selling all my positions right now, then I will be far in the red because there's not enough bid. And not that my positions are so big. It's just I am often in companies without warrants, which makes them less liquid, often with small bids and small asks, um, rapid movements, and so yes, I believe that I'm in the green, but I measure everything. So I'm not. Let me put it like this. So I'm living off my portfolio, which is very smart in junior mining. Um, so I don't know if I'm in the green if I would consider real prices. So what would it take to sell a position right now? Many positions I'm so stuck in that you cannot even count them. You cannot even take the value they represent completely until volume comes in. So I don't treat a share price necessarily for a value of my position, if you will. But I had a pretty okay year considering some trades. One of them was montage. I don't even think cannot even think. Oh yeah, there were a couple of small ones, shell-like companies in the which we also see in the last list, where I buy stock because of debt settlements, private placements, new people joining, and thinking at this point there is a good opportunity for the thing to sort of re-rate because a new story is developing, and then sell, sort of trade it. And I don't talk with people about these companies because I'm quite cold in these things. I'm not calling the management team. on purpose, because I don't want them to sort of build a relationship and then sell the stock 2 months later. This is more of a trading way of doing it. So it's not a good year in a way that I have a lot of liquidity and made lots of money this year, but it's a positive, a green year for me. So it's a long answer to not give you a clear answer.
It again, I think shows kind of that you're typically somewhere kind of in the middle, or holding a balance between what's reasonable and what you can track. But so okay, let's talk about some of the stuff, because you said despite some of the trades maybe that you've done, let's talk about some of the stuff that you did do wrong. Is that something that you reflect on and think like, okay, I made a big mistake? For first of all, missing out on some of these names is what we talked about, was one of those mistakes. But a big mistake where you're like, I bought something, and we talked at the beginning about buying, maybe you bought the right things, but they were bought at the wrong time. Did that happen to you? Did you buy something at the wrong time?
Well, let me give another example where I bought at the right time, but I didn't sell. So knowing why you own it at what point. So there's about 10 names that I own for a long time already, and I have no intention of selling it, even if they have good news or it needs to really spike. And I think there's finally volume, I can sell it, and I think these companies I really own because I believe in the team and in the project. Those things, they just sit there, and I just keep track with these things. But there's also names in my portfolio like, and this is not to recommend it, it's just an example, SRQ Resources. They had a pretty interesting news release about a nickel drill hole, or about a drill hole where they saw visually interesting results. They called it a technical success. It was pretty clear from the news release it was not going to be a high grade hole, but it was just very fascinating that they had an area that was never drilled. They drilled a really deep hole for a tiny company, and they sort of already suggested in the news release this is a technical success because it's a discovery, but there's no massive sulfides yet, so you will not get 2, 3, 4% nickel or something. And I felt, well, this is a $2.5 million company. Let me take a position, because the news release really interested me. It was not one with the super high conviction name. Like there's not like big names involved, like Lundin or anything of that nature. It was really a technical success, which would not. I didn't even expect the market to react that much. I did expect the market to sort of catch up a little bit and perhaps go up 30 or 40% that day on low volume. So, and I almost bought the entire ask at 9 cents. And the moment I was done, and I think there was 1 or 2 investors joining me in buying that ask, not people that I know, but I just noticed that people were buying it. There was no stock available anymore. There were only 28 million shares outstanding, and that was the reason that I felt, well, let me take a position. With good news, this thing could really pop quickly. And with a big position, stock really started going crazy. Went to within 1 or 2 days to 38 cents or 40 cents. And that paper, when there was even enough volume to just sell it again. But I was too intrigued with the technical success that I felt, and I saw the buying coming in, and I felt, bigger parties also see that this is something pretty interesting. And if they drill this hole a bit deeper, maybe they're onto something. And I should have been, normally I would have been hard enough and just say, this was too much too quickly. Let's just sell everything. And it would have been a really, really nice win, even from a dollar point of view in my portfolio, really significant. And I kept the complete position, and the thing came back down at 20 cents. Even started supporting the stock a little bit at 20 cents because I felt, I think they need to do a financing, and rather I prefer to do it at this level than at 10 cents. So I even start buying a little bit to keep sort of support the stock, if you will, which is a stupid thing to do as a small investor, not even connected to the management team. And then the stock went to 10 cents, 8 cents again. So now I'm back at where it started, 9 cents, I think. Nothing much changed because they had a bit of a permitting problem. And now I'm sitting there with my full position. I think not a wise thing. I should have at least sold 50%, if not everything, and just wait it out a little bit, because it was too much too quickly. And I should have foreseen that this thing would come back at least to 20 cents, because a stock cannot go 4 or 5x on a discovery, on a technical discovery, on volume, and stay there. You can only stay there if you have actual results. And I knew that this was not going to be high grade. And then a couple of weeks later, the essays came out, and the thing completely fell back because some people apparently were surprised that the essays were not so spectacular, which was to me pretty obvious, but really in hindsight, not well done, and that would have made my portfolio much better this year, I think, because you would have really taken out some liquidity out of the market, and that would have been a smart thing to do.
Is that a rule? Like, is that just when it's too much too soon, always sell? For I mean, a rule for yourself again, because it is your personal situation, as in, like you live off this thing. So this is probably not going to apply to everyone. But is that a rule that you're gonna, I don't know, start living by? Where it's like, if this thing spikes 500% in a week, I'm gonna de-risk and take at least some reasonable profit, 10 or 20%, whatever it might be.
In almost all cases, not in all cases. If SRQ, let's just stay with SRQ, because they have a good technical team, they have a lot of nickel experience. So if they would have drilled, let's just say 4% nickel, so high grade, over at least 6, 7, 8 meters, maybe 10 meters. So that's something that you really think, wow, this is out of the blue, never drilled before, a true nickel discovery, high grade, or more than 10 meters, but not 1 meter. Then that could be the bigger the intercept, preferably 20 meters, the less likely it is that it was a one-hit wonder. If they would have hit something like that, and the stock would go to 30 cents, 40 cents, and it is not a $2 million stock anymore, but an $8 million stock, I would not sold anything, because I think at that point, if they can confirm this with a second or third hole, then you talk about $100 million potential or way more. And then you wait at least until 40, 50 million, 60 million. Also, then you would have to think about, when is the second hole going to be out? How long will that take? That thing could disappoint. Until that point, no disappointments are expected. So then you plan a little bit, like maybe I should sell a little bit before the next hole, because that thing could completely disappoint the complete story again. So no, in that case, I would not have sold. In this case, I didn't sell it, but in that case, I think it would be wise to keep the stock completely, because such a big discovery and such a small company would really propel the stock, if you believe it's legitimate and real, not an infill hole or a twin hole or something. Really a new discovery in such a small company, not sell until it has a market cap that's more reasonable. In most cases, if there's not a really strong reason for the stock to stay where it is, and that again is a big name, big backer, big CEO name, big discovery, something that really adds legitimacy to the story, in most cases, it's just a short-term hype, a play, and I would just sell. At least I would sell something.
That's actually a good point of you bringing up SRQ, because that is one that you and I discussed multiple times, and also one that I ended up buying at the wrong time. Mostly because it had dropped already, so it had given back, so it made a lot of gains and then gave it all back. And that was one of my main reasons for buying, I think, which was wrong for me too. Thinking like, oh, it's dropped, be contrarian, whatever, buy now, because, if you like the project before, now you should like it even more. But it's just simply the wrong time. Maybe it's, who knows? I don't know. Again, maybe it is the right company. Maybe it isn't, but it was definitely the wrong time for me. And so that's just another point toward, buying the right stuff is important. Buying them at the right time is probably even more important. So I think we've been at it for a while. You told me you didn't want to make this too long, and I can keep talking about these things for a long time. It's something that I think about a lot myself, mostly because I'm not as at doing as well as I would have won. Again, I had a green year, I suppose. I don't track it as closely, I suppose, as many, but I had a green year because I had a couple of good names or well-performing names. But it's not like it's stemming from some sort of a very complete strategy that I can package and use for multiple years to come. So yeah, I get a lot of thoughts, but how are we going to close this thing? What do you want to say at the end?
Well, let me add one more thing on SRQ, not because I don't want people to buy it just because I suggested the name and it's back at that price again. I think it's a $2.5 million company, not a lot. They didn't issue any shares since then, which is positive, but they will have to finance. Bad financing could bring the company in trouble, in my opinion, issuing it to the wrong party. That's the biggest risk, in my opinion. If they would raise money with flow-through funds, I think that would weaken the stock. If they do a good financing and they can drill the target that they want to drill, then it's a cheap but still very high risk opportunity. Uh, Hit is amazing. Miss will be, staying around this price or maybe a bit lower. I think the financing is key, and then of course the drilling. So just consider SRQ very high risk, but it has no warrant outstanding, not many shares outstanding. So if they find something, it can go very quickly. But I want to say that it's not my highest conviction bet or something. It's right now it's at a tricky spot where it needs to prove that it needs to raise, it has to raise some money, and it's always. I mean, if they raise that money with the right party, it could even be a catalyst. Raising it with the wrong party could even be, something that would I wouldn't say end the story, but would make life difficult. So I consider it a very risky thing. That I just want to make this closure here. I still own it. I have no plans to sell it. There's also no liquidity to sell it, so it's just an illiquid name with another company with a high potential project that may never pan out. So that being said, yeah, I think the idea was to really look at the winners this year. We talked about strategies a bit more than expected. I think it's obvious that there's not many in a year like this when there's no real inflow of capital. Metals did really well. Not really a lot of inflow in junior mining stocks. If you don't have a bull market, you don't have a really bad market either, sort of a bit of a neutral to negative market, it's not easy to make money in the sector. And you can see that it was really event driven. Either somebody new joining as an investor or as a CEO or a team change, as I called it, or a discovery are almost only the names. And you had a couple of metal related, like antimony was strong this year, and antimony stocks, which are only a few of. Also, a couple of promotes, really big promotes, in my opinion, did really well. So it's difficult to make money in this sector in a bad market. So you have to be really picky when it comes to events. And my conclusion is almost always team change or backer change, the new investors, or a discovery. Sometimes in small companies, a new project could be changing the game, but I think it's all about who is going to run the company or is there a new big discovery are the only two things that can keep a story at a higher level for a prolonged period of time.
I think this was a good chat. I think we can close it here, and just still my takeaway is that junior mining is a tough business, and failure is the norm and should be the expectation. And hopefully we have a better 2025 as a whole for the sector, but that almost wouldn't matter to me, at least, because I would like to build a strategy that is sustainable in any type of market. And so, yeah, it's tough, but this was a good chat. I don't have anything else. Thank you so much for doing this.